Today we're talking about an extremely important topic, which is managing your financial destiny. And today I will give you a guide on how to start investing during a market crash like the one we have right now. Because truth be told, right now is actually an excellent time to be starting your investing journey. Contrary to maybe, the perception of the media, what you're hearing and the emotions that, many people potentially associate with the current moment, which is, losing money on paper. Maybe they realize their losses. But again, for you, if you start your investing journey right now, or even if you just want to, accumulate more assets into the stock market, there is a fantastic time right now to do that. So let's look at three things today. First of all, what's ahead in the market. Secondly, where are we right now? We're going to look at some key charts. And then thirdly, I will give you a simple mock-up portfolio of how your portfolio should look like if you want to start investing with $10,000 right now. So let's dive right into it. If we look at the current state of the markets, right, we can see, let's start with the S&P 500, which is the US index. You can see, just in a 1 week performance, the assets are down massively. Nvidia minus 10%, Microsoft minus 5, Apple minus 18, Amazon minus 8, Google minus 5, Meta minus 11, absolutely, wrecked, and a lot of blood in here. Also, if we look at the entire world, there's not a different picture. Europe is very similar. China, Alibaba minus 20%, TSM, the semiconductor business from Taiwan, minus 12%. So basically everything is down right now. And there are a lot of fears in the market, primarily driven by the tariff news that has really, escalated over the last, 7 days or so. And, that kind of changed the projection going forward. And if we look at the poly market odds of a US recession in 2025, for example, you can see that just, in the last 7 days, the odds spiked up to 66%, which is massive, down from around 35 mid of March and just around 20% in January and February. So investors are completely changing their perspective on the outlook for the economy. That's probably also the main reason why the markets are absolutely puking and there's so much blood on the streets. If we look at the interest rates, we can see that there has been a change already compared to the last video that I did just a week ago in terms of how many projected rate cuts we see this year. Now, with inflation coming in very low and also, oil and energy costs absolutely dropping because of the fear of a recession, right? It makes a big part of the CPI, the inflation data. It is very likely that inflation, will drop significantly now and already has dropped. That's why, investors are also projecting a better liquidity situation over the, next 6 to 12 months. Because during the last video, we only projected there was a projection of only 2 rate cuts. Right now, we do see more. For May, there's no rate cut still, as the main projection. Then in the June meeting, there's a, 25 basis point cut. In the July meeting, another 25 basis point. And then either in September or October, another 25 basis points. And then towards the end of the year, beginning of next year, another 25 basis points cut. Accumulating to 4 rate cuts, each 25 basis points, so a whole percentage point reduction until the end of the year. That's a lot better of an outlook from a liquidity perspective for the market, but it remains to be seen if, and how the Fed pivots their outlook and their own projections of the economic sentiment based on the latest tariff news. And in addition to that, we also keep a close eye on the quantitative tightening and quantitative easing that the Fed is doing, because right now we're still in the tightening phase where the Fed currently, sells off assets from their balance sheet to a rate of only like 5 billion per month. We were previously at 25 billion treasuries being, sold off the balance sheet. So now there was a strong reduction, but we're still in the tightening phase and not in the easing phase. Easing would mean the Fed would add to their balance sheet, which would be very good for risk on assets. So that remains to be seen. But from an overall perspective, we're in an extremely fearful state of the market, as you saw. But that is, again, contrary to common belief, actually a good thing if you have capital to deploy, because when others are fearful, basically you should be greedy. Be fearful when others are greedy, and be greedy when others are fearful. Right now we're in a fearful state of the market, So you should be greedy. You should look at accumulating assets at a discount. That's how you need to think about it, because great investments are, to a big extent made at the time of purchase, because you purchase them at a discount, right? If you're looking at a real estate object, for example, you would want, to have a cooling real estate market so that, the prices are not inflated. Same with the stocks, because we're now approaching very key levels and some very reasonable P to E ratios, so price to earnings ratios. So I want to look at some key charts. Let's look at, first of all, the S&P 500. This is the weekly chart. So you can see this sharp drop off, during the last, 2 months or so, dropping more than 20% intraday today, down to the 2021 highs and to prices we've never, we've not seen or revisited, until beginning of last year. So January 2024. So big sell-off. The Nasdaq, due to the nature of the technology assets in that segment, just more volatile, dropped even 25% intraday. If we look at the MSCI World, also 25%, that's a massive drop. So you can see we're just, revisiting 2021 levels right now, which is very crazy to think since we're in 2025 and there's been a lot of development, right? As you can see, the market is just in a very fearful state, right? We're just dropping very aggressively. If we look at China, for example, China is a slightly different story because China never fully, recovered from the 2021 highs, when the economic, projections and growth rates for China were just at a peak. They never really recovered, and we're now, from all-time highs, we're down over 50%. The question is going to be, what is the outlook for China? Of course, China will always play a very important role in the world economy, and seeing that the market in China is so down, it might be a good time to invest, since it is comes at a bargain. If we look at the European index, you can also see it dropped, around 15 to 20%. Right now, it also lost this key level, this daily weekly 50 EMA that was holding previously. So overall, you can see massive fear in the markets, high volatility to the downside. I want to touch on some individual stocks as well. Let's look at Nvidia, one of the biggest in the world. In terms of publicly traded, right? Intraday, it dropped by 43% from all-time highs. It's crazy. Very significant drop, of course, comparing to the overall history of the acceleration of bullish price action, right? It's still up a lot, of course, but it already dropped 43% from the highs, from $155 intraday to $86. So depending on what your stance is on the AI boom and, demand for processing power, there is definitely a discount right now. If you look at Amazon, for example, Amazon also down around 30%. Amazon also is a massive behemoth of a company, and being down 30% within just a couple of weeks is absolutely massive. Apple actually just lost a key trend line today or this week, being down 32% and not really having recovered intraday today. So this looks from a short-term perspective a bit more bearish than the others. You could see also it dropped a bit further, but long-term still has great projections. If we look at Meta, also down intraday 35%. So there's a lot of fear in the markets. Tesla also being down around 50%, that already has been downtrending since a bit longer time frame, just due to the fear of, or not fear, but poor data when it comes to growth rates in the electric car market. And of course, Elon's involvement into the politics and government probably has not really helped the stock either. Then another one I wanted to touch on is Coinbase. Coinbase also being down 50%, 55% in fact, from the highs, which is absolutely massive. If you think about that, since Coinbase have posted very good financials, having a massive revenue growth over 100% year over year, 40% profit margins, and again, crypto is not part of the tariffs doesn't affect crypto. It does feel like there's a lot of fear in the market, also driving down stocks which are not necessarily impacted that much directly. What we're looking at is massive fear in the markets. Of course, nobody, truly knows where the bottom is, though we can see that we're definitely in bear market territory, approaching recession levels, being down over 20% from the highs. That is a massive flash crash. Just one more time, just to put it into perspective, during the COVID crash, the COVID news where a lot of people thought the world would be ending. There was a flash crash just in a couple of weeks of minus 35% on the S&P, right? And our current, drop has been 22%, which is already a lot if you compare it to sort of the COVID news back then. So it remains to be seen how further we dip, but it already has, a significant, retracement has already happened in the markets. And that's why, in my opinion, it's a fantastic time to invest and start your investing journey. If you look at the S&P 500, for example, has a proven track record over the last 30 years, returning on average 9.8%. Of course, before factoring in inflation, but still after inflation, above 7, which is an absolutely massive return, by having a long time in the market, but also timing the market in the sense that whenever it drops significantly, you add more, can really help your long-term portfolio growth. And right now is such a time where it does make sense. So now we have covered what is the projection moving forward. Where do we stand right now, on the various, geographical markets. Now, lastly, let's look at a mock portfolio of how I would structure a portfolio if I would want to invest $10,000 right now and start my investing journey. And for that, I have basically done a very simple table in Excel of how a mock portfolio could look like. First and foremost, the investing period should not be a single day. Generally, if you would want to invest, $10,000, for example, you should split that over the course of a couple months or a couple buys, because if the market dips further, you want to have additional liquidity to even have a better entry price. So, you don't necessarily have to have 3 months. If the market, if you enter a position right now and the market drops, next week, another 10%, might already be a good time to buy a second round of your asset, of your ETF, right? If the fear continues, right? But definitely keep in mind that you would want to have your liquidity split. As a retail investor and also as an institutional investor, nobody can really predict where the market bottom is going to be. That's why DCAing, dollar cost averaging, is such an important and crucial tool when it comes to investing. For this portfolio, my recommendation would be to put the majority of your investable assets into low-cost ETF index funds, because they have a proven track record, through fears, recessions, until the boom. They are a very consistent investing asset, and that's why the majority of the funds I would allocate to those ETF funds, because you could really hold this for the long term until your retirement. And here I would recommend a split between the S&P 500 and the MSCI World, both very respectable ETF products, and maybe having a smaller allocation to the emerging markets here, which have a higher growth potential. Whether it's generally, let's say, Asia, if you want to have maybe the BRICS countries, there are also various ETFs on those, or if you want to have specific exposure, let's say to India, for example. I truly believe that there's going to be a very explosive growth within the next 10-20 years. Then definitely makes sense to be exposed to that market. And basically here we come to 100% of the 80% portion of the portfolio. So basically you would invest around $1,000 into S&P and MSCI World and around 500 into the emerging markets. And then, you could also pour a portion of your investable assets into direct companies, right, into individual companies. There is a bit more risk, right, because you're not diversified as much as with an index fund. Again, the S&P 500, there are 500 companies that you're buying with just one purchase, right? This $1,000 gets allocated not evenly, but relatively to the market size of the companies among 500 companies, right? And here you would just buy one particular company. Of course, also has higher upside potential if the company really performs well, though it carries extra risks. That's why I would not, recommend having more than 25% of your portfolio in individual companies. Considering also that the 25% is not one company specifically, but like a couple or a list of companies that you believe in. In this case, I put 10% because it's a very reasonable allocation. And then just splitting it between, two companies that you believe in. For me personally, it would be, tech growth, future-oriented companies. So here I put Coinbase at 50% and Tesla at 50%. as true enthusiast and a believer in the long-term value that cryptocurrency provides, in the real world application, whether it's just store of value or decentralized finance or encryption or just global money markets, being able to send money across currency ecosystems easily, just one or like results in me wanting to allocate a portion of the portfolio in crypto. In this case, I would recommend maybe a 50-50 split, 50% in Bitcoin and 50% in ETH or Sol, as other very high cap assets, and just being allocated like that in the market. And that would basically be your mark portfolio. You can tweak it and twist it to fit your individual needs and biases. Though what I definitely would recommend is having a solid, risk management in place and to ensure you're diversified properly and also diversified when it comes to timing the market and not, allocating all at once, but allocating step by step and increasing your exposure as time progresses. And then, of course, after you have invested your $10,000, your investing journey shouldn't stop. You should continue to invest long term to really compound your wealth to levels that you probably cannot grasp right now, because in a couple decades, the compounding effect can be absolutely massive if you do this investing journey correctly. That's why I would recommend to definitely continue to DCA into the markets, using at least 10% of your income put towards investments, or if you can more, of course, and then continuing to DCA into the markets just with the same split as you already had in the beginning when you allocated a big chunk into the markets. So this is your mock portfolio. I can only recommend to get started with your financial journey today. Let me know if there's any other question you have in the comments or any other way I can guide you through this journey. Subscribe and like, that would really help the channel, and see you in the next video.